I still don't really understand because you're focused on CBDCs, which I don't care about.
That was Raoul Pal. Raoul's an economist, investment strategist, and CEO and co-founder of Real Vision.
Fair enough.
And this is Blockhead's columnist, Jon Reiter. In this episode of the Blockcast, Jon gets the opportunity to speak to Raoul about the value of cryptocurrencies in the real world. And this is how it unfolded.
Hello?
The Blockcast.
So I've been only doing sort of crypto quantity stuff relatively recently. So it's 6 months a year or whatever. So it's an interesting exploration of the space. You've talked a lot about how all assets will get tokenized. There's no way to get long how many assets are tokenized, right? So how do you think about approaching that problem? Because, you can just wrap assets, whatever. You can tokenize infinitely in that sort of sense, which is not meaningful. And how do you approach investing in that kind of environment?
Well, the real answer is what chains are going to dominate, right? Because I figured out after a lot of work what drives the value of a chain is obviously the network effect, Metcalfe's law. And the way to best estimate that for idiots like me who can't mathematically model it is straightforward value exchanged on chain in a period of time. So let's say a month, how many billions of dollars exchange versus the number of active addresses. You make that chart, it's like an 87% correlation to the price and doesn't include price. So therefore, if more things are going on chain, more value will get transacted. Yes, some of these are layer 2, so they don't really affect the layer 1 as much. But over time, the more stuff that you get on it, it increases in value. Now, the question is what chain? And the way to do it is just have a broad base. Now, there's things like the Bitwise 30 of the top 30 chains. It's like an index. Now, it's not great because it's a closed-end fund trades at a discount. But it's basically, just treat it like an index fund. You'll get it right.
Well, okay, so if you approach that as sort of traditional investing kind of a style, you're not going to get forever tremendous compounded annual returns because improved efficiency is a thing we've seen for 100, 200 years, but it provides an incremental GDP uplift, but it's not a thing that goes on forever. And
well, I think the market cap,
it's hard to find that.
No, it's not, but the market cap goes from the market cap of the space of these kind of chains go from wherever they are now, $1 trillion. I think they go to the size of other asset classes, which is 200 to 300 trillion. Okay, I'll take that as a compounded return.
Well, okay, so I guess this is something I was planning on going to later, but we can. One of the big use cases is stablecoins, where there is a possible competitor that comes in and says, I don't need any fees because I can just do dollars for free. Right. So, and that's not a thing. When the telegraph came about, it didn't face that. I'm not suggesting there aren't value there's not value that can accrue to other versions.
No, that sort of that doesn't make sense. So, if you think about what we're doing now, if we were 10 years ago, we'd be paying for this. It's now free. So we've got like a layer 2 application on top of the internet. We're paying for our internet connectivity. What is the global value of the internet? Well, it increases exponentially in value the more applications you have on it and the more connectivity between the people, which is Metcalfe's law. So
the value of the telecom providers hasn't accrued exponentially.
Well, because they don't accrue the VAT. That's the big breakthrough here because nobody owns the internet. So if you're a stablecoin guy and you create a stablecoin with zero revenues, good luck to you. You're worth very little. It's just a utility. So there's some utility value, but you can own the protocol layer, which is the difference with the internet. You can't own HTTP.
Well, okay, so I guess this is a bit too in the weeds of stablecoins, but I guess earlier what I was referring to is if the government decides this is the way we're going to do stablecoins and these stablecoins will be fine, and you can't encash other stablecoins. The government never said if you don't pay the postal service to deliver emails, you can't deliver them. But for banking services, that's kind of a thing, right?
it's almost certainly going to happen.
Well, then how is there value accrual if they, I mean, this is not, it's not meant to be confrontational, right? I don't mean it that way.
No, but, it's an interesting question. I don't think of stablecoins as value accrual for the underlying network. Yes, it still needs to run across the rails of the network. What are you using? Are you using ETH? Are you using Tron? Are you using whatever, right? So they derive in some of the value that gets exchanged on those rails. So that's okay. The stablecoin has no particular value except its utility case. But what you are doing is enhancing the value of the network because you're allowing all of the participants. So if the US decides to have a stable coin, there's 350 million people with access to this new technology, which is blockchain technology. So therefore, the probability of an increase in use of the network goes up.
Well, okay, so I guess it's a thought about sort of how much of that increased use generates value for anybody. I mean, if you live outside the United States, you're familiar, I'm familiar, payments are free, right? There is no value accrual to that sort of service. Whereas domestic American payments are quite expensive. Things like SPVs, the idea you can set a DAO up that's cheaper.
Okay, again, I think you're kind of missing the point.
Okay. Mm-hmm.
The reason the banks make so much money is they own those rails. So the rails facilitate the ability for them to drive value to themselves. So even though that part of the system is free, so the app that you have in Singapore to transfer money is irrelevant. What you're actually doing is they are just making the use of their services as a bank easier, which allows them to maintain profit. So it's not the payment rail. The payment rails are just a facility, much like the use of Facebook is free. It actually just drives revenue to Google or Facebook.
Okay, but I guess it's hard. I mean, it's hard for me as a sort of old school derivatives person to understand how, if you can't impose the CBDC on people, you can't just impose and make these transfers free type arrangement. I mean, you could have a US, UK, EU bilateral arrangement.
I don't have a problem with that. That's just one part of the ecosystem. And the CBDCs are going to come. Some will be private sector, some will be state sector. And all that's doing is enhancing the value of, let's say, the network of Ethereum, because now you can plug your bank account directly into this new Web3 world, so you have a seamless transition into a new world. Much like your mobile phone now is your seamless transition into the internet world, mixed with the 3G, 4G, 5G world.
Okay, so I guess this is where it becomes sort of difficult for me to sort of square these two things. Because if you have permissioned networks on both sides, why you would have to rely on a non-permissioned network to transfer them becomes hard to understand. I mean, Swift makes sense because you have to have a banking license to use Swift. Fine. If you've got some sort of free, whatever, unbridled, uncontrolled way of transferring fiat value, that's fine. But then the Bank of England and the MAS, that way, could just set up a free transfer network, and why would anybody pay the gas fees?
And they probably
it's
will.
A free market.
Yeah, but stablecoins is just a small part of the market.
Well, okay, yeah. So I guess this is really okay. So this is what I was trying to get at.
Stablecoins is just part of it that's necessary now because there are no CBDCs because we don't have digital fiat. So digital fiat does exist in India, for example. It does exist in some places. So the UPI system in India works pretty effectively. That wasn't on blockchain rails, and that's okay. It doesn't need to be either. What we need is the interoperability with fiat world with Web3 world. And so that's just a small part of the equation. What we're actually talking about is what are the use cases for Web3, meaning all of cryptocurrency, the protocols, and the applications layers that built on those. Some of those will be the securities industry, because you and I know the amount of tickets you left behind of OTC derivatives that were stuffed under desks and in drawers because they're all individual contracts. And it's a bloody shit show. Nobody knows who owns them. So if you put those on chain, when a counterparty goes bust, you can get to the bottom of who owns what pretty quickly because it's all on chain.
So, I guess that sort of gets to the question of how much of this is just software engineering and how much of this is actually new. I mean, certainly making less expensive database synchronization primitives is fair enough. I mean, financial technology is very bad, and I think everybody would agree in general banks don't do a great
No,
job.
it's the primitive of the database itself, not the cost. The cost is just part of the equation. It's the fact that you've gone to first principles and redesigned what a database is and how to make it secure in this digital realm. So right now we use centralized databases of which the data gets hacked, and we see it all the time, right? We see it at state level, we see it at corporate level, we see it all over the place. So once you've got blockchain validated data, what you've got is a different level of security and proof. So it's not about going to court to prove who has the ownership of one asset. The ownership is on chain. It's instantaneously provable. And you can program that chain to instantaneously transfer assets, which is what DeFi does. DeFi instantaneously liquidates your position and takes control of your collateral in the event that certain conditions are met, without anybody in the middle.
Well, so I guess we can put a pin in the question of sort of recent developments in DeFi and how much that automation turns out to be real, which is a question everybody's
that was CeFi, not DeFi.
Well, yeah, I guess we can go into it. So Solend is really an edge case, right? So 90%, 99%, whatever it was of the voting was one guy. No one's pretending that's decentralized, but it's hard to know in advance if that's the case. I guess what I was going to ask is, if your base layer is a CBDC that's completely controlled by somebody, then the control exists on some level. So exactly what they choose to reverse or not may or may not matter. But if you're going to go to decentralized protocols where it's unclear, like I will concede that Uniswap, 100%, nobody can change, right? That's out there and it operates autonomously.
But you're also conflating different currencies, right? We're living in two states here. One is the state that you physically live in. Well, three states. One is the state you physically live in. Two is the US dollar sovereign state, of which we rent their currency, right? And thirdly, it's the state of ETH or whatever actual crypto state, network state you're within. So you've got three different currencies at play here, and we can't conflate the different currencies. So the central banks with their control of the CBDC layer don't control the ETH layer. We're free to transact in ETH all day. If you look at the NFT market, it's entirely denominated in its own currency.
Yeah, so I think that's what Arthur Hayes referred to as farm-to-table Bitcoin economies, right? But it remains unclear how you can really do a full circle economy where people buy food that is entirely on-chain. Right? I mean, that's...
Does it need to be that? See, again, we're conflating physical with digital. Okay. What we're talking about is the transfer and access of all digital and storage of all digital assets. Now, yes, we can put property on chain because it's actually easier. It's a quicker way of transacting. We don't need a notary in the middle and all of that kind of stuff. Yes, a lot of assets can go on chain, but the thing is, do we need the system of money if we're happy to use fiat? Right now, most of us are happy to use fiat. Yeah, sure. In some countries, you're not because it keeps devaluing. But most of us are pretty happy. You're in Singapore, you're pretty happy to use the Sing dollar. It's a relatively stable currency. It's all fine. So it's not that. It's just that the new world is priced, the new state is priced in a different set of currencies.
Well, okay. I mean, there's a clear use case for people who live in countries with restricted currencies that can't access hard currency. And this gives them a facility for getting hard currency bank accounts, right? It's sort of old style EM vocabulary. I guess for me, the challenge there is like, I can have a USDC account or whatever. I can have a dollar account at Citibank. You presumably have Citibank accounts with. Giving someone in Myanmar that's a dissident a US dollar bank account is definitely a new thing. But it's hard for me to understand how that works long term because, I mean, formally speaking, it's illegal for them. And, that's that is genuinely new, but it's weird. Right. It's in the old days, as soon as Martina Navratilova asked for asylum, she got asylum and she was OK. But now you can help them before they're across the border. And that's genuinely
here's an interesting thing. I asked the guys at QCP who are based in Singapore about, OK, who's using all these bloody stable coins? And they're like, well, one of the big things here is Asian exporters. I'm like, really? He goes, it's so expensive. If you're a Malaysian corporate dealing with a Chinese corporate, you've both got capital controls. The ringgit yuan rate has like a 10% bid offer spread. It's like the cost of doing business is enormous. So they use stable coins. And I'm like, really? He's like, yeah. And it collapses their costs.
This is your QCP interview from like a year and a half ago. I love that interview. It's very entertaining. And I don't mean this, try to say this gently, it's not a judgment towards anyone. Most of their use cases are explicitly illegal for at least one of the counterparties. This is not meant as a judgment, right? But like capital controls evasion is,
or do you put it another way, which
line to take.
Yeah, I mean, or you put it another way, it tries to avoid the frictions. Now, my guess is, again, as you would say, as you know, you've been in emerging market FX, right? South Africans have dealt with this for you. Everybody deals with capital controls. And the central banks understand that too. And it's a game of allowing the ability to get around capital controls without it doing at scale. So it's fine. Nobody minds a bit of capital leaking out. The Chinese do, for example. But what they don't want is all the capital to leak out. And, if you own the CBDC rails, you get the ability to KYC, AML, anything coming in or out of your system.
Yeah, okay, so this is the, Hong Kong guys with the gold bars and the suits swimming across the harbor of the 60s story. Yeah, fair enough. But it's hard to understand how that allows a meaningful amount of unbridled growth. I mean, this is not meant to be negative. I don't know how one...
I still don't really understand, because you're focused on CBDCs, which I don't care about. It's like, yeah, money's going digital. I'm talking about all of the use cases of smart contracts, of every contract. Essentially, think of it, the hack to think of it is every contract on Earth, of which almost everything we do is contractual, including us talking today, it was a social contract. But almost every contract can go on chain and will go on chain. So that's tickets to concerts. It's anything you own or transfer in the digital world. It's your set of IP rights. All of these things are much larger than anything to do with the fiat money transfer system. It's an entirely global business model that's being upended from scratch.
Okay, so that gets back to sort of some of my first question, which was, I mean, if you imagine all concert tickets are NFT, okay.
Yep.
There's no way to go long concert tickets that get
NFT'd.
There is.
Yes, there is.
Just move the cheaper rails, right? It's not...
It's not about cheaper because there's a trade-off, right, between security and cheapness. So certain things, there's competition for certain chains for certain things, right? As there is in life for everything. So for example, some people will use DuckDuckGo instead of Google and it's an inferior product, but because privacy matters to them more. So again, I go to the point is, if you're asking the question, which chain is going to win and how do I profit from it? The answer is, I don't know. So how would you solve for that? Solve for that by a broad-based basket. Now, if you solve for it in an index-style product that automatically rebalances when something comes in the top 30, we've learned this, even though we're all cynical, it actually works in the S&P and indices, is you generally capture the value of the equity market over time. It's not perfect because you can always try and create alpha by doing other stuff, but generally you get the beta. And in this case, if the beta is going from $1 trillion market cap to $250 trillion market cap over the next 15 years, then that's all you need to capture. Everything else is just trying to be too smart.
I mean, certainly from an equity market perspective, and you imagine how the petrochemical industry evolved, whatever, yeah, that's of course correct. But the way crypto has evolved, you've really got two things that have one and then a thing followed it up. And then below that, it's been kind of a constant churn. I mean, Solana is still there somewhere near the top. AVAX is hanging out, somewhere. Avalanche is along. But it doesn't look like the competitors to Standard Oil, right? I mean, we've seen industrialization before in a number of industries, and it's just not evolved that way. It feels a lot more winner take all in the way that Facebook took all the money. None of Facebook's competitors is worth anything. This is not a criticism.
This is why 80% of my allocation is ETH. Right?
Okay.
That will change over time. 80% of my allocation is ETH. I've got a broad basket of other stuff. And, I think Solana's probably the ETH of the next cycle. So that's kind of how I think about it. I never come at it with, this is going to win all. But you can see network activity. And if network activity grows or dies... Now, over time, ETH, I think, goes down in terms of dominance as other chains find use cases. So certain things will be faster, certain things will be cheaper, certain things will have more privacy, and use cases get pushed to different areas. Some will deal with NFTs differently. Whatever it is, we don't even know, right? And that's the point. We don't know. It's like you and I arguing about who's going to win the internet in 1997. We would have got it wrong.
No, okay. I mean, that's clearly fair. I mean, nobody got that one sort of clearly correct. I gave up on a search engine in the late 90s because we couldn't figure out how to monetize it. So, credit to those guys. But it's
do you remember that? Right. That's a really interesting point, right? Because we were all sitting there, when this is all coming out. I was at Goldman, and we're like, well, nobody's going to make any money from this shit. Why would you? Which is the point you were making a second ago, but you missed the fact that it was actually network effects that created all of the value. Because what you did is once you got a gazillion people using the application, what you captured was all of their data, of which you can build infinite amounts of businesses. So you created network effects at scale by using something free, which was search. It was staggeringly genius.
I mean, I guess I would disagree that the thing about Google that was so much better was the user feedback. It was the inference, the discovery that the network structure would let you improve search effects. But that's a totally unrelated conversation. That's a sort of podcast that can be done at another time. I guess the basic things that were done on the web at that time were kind of things you already did, right? I mean, you remember buying plane tickets online, and it was cheaper, it was easier, it was quicker. But it was the same stuff. If this time it turns out to be the same stuff,
it wasn't.
I mean, email was just mail, but it was cheaper.
That Google search box didn't.
No. Okay, so search was totally different. I agree, that was a totally different thing.
It was data. The data layer was where all the value was, and so
the structure of the data. Okay, yeah, fair enough. Okay.
Yeah, and what you could do with it afterwards, right? So the data created the internet that we know today. Was created from the data layer of the internet from the first use cases.
And I suppose at this point it remains unclear. I mean, structured data, Google was about shredding pages properly. Alta Vista, Ask Jeeves, were about shredding pages properly to find sort of clues as to what the good information was. That's no different than metadata tags on an NFT, right?
Let's approach this another way.
Please.
Back in 97, what was the total value of all of the component parts of the internet? So maybe there was a bunch of companies, I'm going to wildly guess here. Let's say they were worth $30 billion, right? They weren't worth a lot. And then we add the layer of, okay, to make that happen, let's add all the telcos in. Let's add in the computing companies, etc. Right? So we get to a number, call that, numbers were much smaller then. So call it $1 trillion for maths, right? Or $10 trillion, whatever the number was for all of the telcos. So now that is the internet. Now, if you revalue that now, what is that worth? I have no idea how big that is now, but I would guess it's gone up exponentially in value because it's a network.
I mean, certainly Verizon and Vodafone have gone up a lot, NTT, whatever that mobile phone that turned into. But those were networks that were of tremendous value to start with. I guess, and maybe this goes back to your point about the fundamental sort of difference in structure. Here, on blockchain networks, the value accrues to the token holders, which is like saying, I mean, the only company, when you were saying 1997, the only company that's still around that's large is Microsoft, maybe Cisco, right? Other than the telecoms. Vodafone is like, what, the blockchain native tokens? I mean, that's a totally different way of doing it because it's their incumbency.
No, because the token captures the entire activity across all component parts of the network, at least takes a part of it. So it's very different to any of those models because you're actually sharing in the network. So let me give it another way. The closest example I can think is the Catholic Church.
Please. Mark Cudmore at Bloomberg has a very Catholic explanation for this. So, we can talk about that separately.
Is because what happens is in the Catholic Church, there is a gigantic network of 1 billion people that grew over time. that group of people participated in the network. So what they did was actually they kind of invested in the network, which was the whatever that money is that you have to hand out after everything. That then gets piled back into buildings and paying for priests to expand the network. So you end up with all of these churches, which the value of the network increased both because of the capital assets that they appreciated and the fact that more people wanted to be part of it. Because my guess is back in the 1600s, it's pretty glamorous to go into a big Catholic church in Spain and go, oh my God, look at the awe of the money and power of God and the church, right? And that is how you participated in a network. We don't participate in the mobile phone networks. We are users. Now, if you're in Facebook, right? If Facebook had tokenized at start, or let's make it in simpler terms, if as a Facebook user, you were given Facebook shares, I mean, that is what this is all about. Is so every user gets rewarded for the activity that's on the network, not just for the utility.
Well, so, okay, I guess there are two separate cases here. So the mobile phone company, the telecom provider, and the social network are different things. Facebook has competed however Facebook has competed, and their moat is whatever their moat is. It's been, I mean, they beat whatever social networks from 20 years ago. But the telecom providers have a kind of government-insured moat in some ways that starts to feel, let's come back to the earlier conversation, starts to feel a bit like a CBDC. Like the reason Vodafone can charge what they can charge,
which is why they didn't capture the supernormal profits after a while. They used to in the early days, right? And then they stopped. They became a utility, and that's just like
because of sort of popular outcry against egregious mobile phone fees. I mean, I had a Verizon mobile phone for years. No one in the world likes Verizon.
No,
I know this is being recorded. It's fine.
Yeah, it was competition.
Well, I mean, competition is hard. You have to get licenses. You have to convince the government to sell the licenses. So like CBDC, private currency competition, it's hard to see how something where already the basic transfers, and again, I know you're saying CBDC is not the base case, that's fine. But, well, okay, we step back. One of the favorite use cases I like to kind of work through in my head is why don't we have a multi-currency stock exchange where you pay with a CBDC, a variety of CBDCs, and the London, Milan, New York, whatever, Frankfurt stock exchanges are all the same, and you bid in whatever currency you want. It doesn't really matter. That's a software problem. If this starts to be a thing, why don't they just erect a software solution and stop it? It seems like the competition can't accrue that much value. I mean, Verizon, Vodafone, NTT installed mobile phone towers. They could provide service. There was no easy way to get licenses and compete with them. Whereas a multi-currency stock exchange, TransferWise with central bank digital currencies, just takes all the money away, right? It doesn't seem that hard to compete this one away. John Rockefeller had a proper moat.
And that's fine. The value of transferring money should be zero. So competition will drive it down to zero. By the way, you also need to look up. Look up in the sky at night and realize that Starlink and the sheer number of satellites that are going up from SpaceX are creating this all over again, and they basically have a global monopoly on space and the use of data going from Earth back up there, back down again, and intraspace. It's a fascinating another network that's being built in front of our eyes on non-sovereign boundaries. So why do you think Elon Musk talks about Doge so much, right? He's actually going to use this as payment. So I interviewed a guy from NASA, ex-NASA, who's now a VC in the space from the Jet Propulsion Labs. I mean, he's been in the space industry forever. And that interview, Leon Alcali, was incredible because I was like, oh, I didn't know any of this stuff. The fact that there's already server farms and data farms in space because the satellites that it's inefficient to beam the data back down to Earth. So their computational stuff is being done in space. They need a payment system. They're using cryptocurrency. So because it's a non-sovereign ability to do stuff.
Okay, but I mean, this is an old computer science thing, right? You can fix bandwidth with money, but latency is bound by the speed of light, so you can't change it at all. Marginal increases in latency matter for very few applications. They matter for applications. I mean, Flash Boys is the most famous example. But people don't really care about an incremental 3 milliseconds. They care about the ability to do stuff. I guess it's
No,
difficult.
it also keeps it. Don't no. It's much bigger than that. If you don't have to send your data back down to Earth, you're not restricted by the Chinese state, the Myanmar state, the whatever state, right? You have total sovereign freedom there to utilize data. I mean, it's terrifying, but that is what is going on, and that is coming at scale.
Okay, so I guess that connects to another sort of one of the areas that I find difficult to understand, which is, I mean, you've seen examples of DAOs that are clearly not decentralized. They're just an LLC in Indiana, and there's 6 dudes in it. And if you're truly without somebody you can point to, right? It's the usual, he's in charge. That's a legal strategy, and when it gets tested in court, what we're currently seeing in the collapse of certain types of services in crypto is going to test that in court, right? How do we approach use cases that seem durable? Because, I mean, again, the idea of providing hard currency bank accounts to dissidents in whatever country where you disagree with the government but agree with the dissidents, that's fine. But it's hard to see how writ large, if you're not running satellites in orbit and pretending you're free of the jurisdiction of any court on the planet, they're owned by some company, it's incorporated somewhere. If the court there disagrees with what you've decided to do, the decentralization may not be quite so real. And we don't have a lot of examples of things that are
Well, it depends what is decentralized
managed.
Most of the DAOs are done for legal purposes to try and avoid getting sued for securities laws because the legal framework's clunky. But Bitcoin is a totally distributed, impossible to prosecute network. So you either have to try and shut it down. There's nobody you can go after. There's nothing you can do. It has no corporate status. And corporate, if you think of the word corporate, is to treat somebody in legal terms as a human, right? It is impossible to do with a distributed network.
Now, it's certainly an interesting intellectual exercise whether the Bitcoin or Ethereum networks can be prosecuted. I'm not a lawyer. You're not a lawyer. Whatever,
Impossible.
Well, I mean, enterprising prosecutors have had a go at the mafia in ways that are creative. So I'm not really sure. I mean, to me, it seems like a lot of this stuff is crying out for a RICO prosecution. I'm not a lawyer, and I don't really, I can't speak to that in detail. But it's interesting. Every attempt to avoid the state has either resulted in overthrowing the state or the state, coming for you. You remember the car bombs outside the Palermo airport, 1991, Falcone, and you come for the state. What's it's a Shakespeare thing? You come for the king, you better not miss, right? It's an interesting tension. I'm not sure people really want to take that line, right? Your DAO that's sort of soft decentralized and tries to do some kind of KYC, maybe a safer route. It's an interesting thought process. Anyway, I'm not sure the space is advanced to that level yet, but maybe that's what's going to happen now.
I mean, if you read Balaji's books or hear some of his podcasts, and I think he's absolutely right. I mean, this is a battle between state and decentralized, state and the people, but in a different format without the pitchforks. It's basically, I'm taking my toys and I'm leaving your room, and I'm going to go and play with my toys myself. Now, is there going to be a battle over this? Yes. And it's a regulatory battle. Who's going to win it? Well, in some places it'll be the state, in other places it'll be the people. Right now, China has banned a lot of this activity. It hasn't gone away. It's still there, but it just moves. Like the black market never goes, right? The black market is the oldest market of all. And that's
the joke from the Hunger Games movie where they say to shut down the black market, and it's one particular building filled with that. Yeah, fair enough. But that's not driving stuff further and further in a corner. I mean, one outcome here is something that looks like 1960s offshore finance. I mean, you're in a capital of 1960s offshore finance. There's a way that sort of permission CBDCs and non-permission blockchains allow something like that to occur. But that was always kind of soft permission to rich people and corporates, right?
Well, again, that's just one edge case. But look at the size of the Eurodollar market. I mean,
but that was always a highly regulated market, right? Nobody asserted that dollars in London were exempt from rules.
It's not regulated. A South Korean bank can basically create Eurodollars without the Federal Reserve. because there is a global exchange of money that takes place at a globalized interest rate, which is the euro-dollar, the LIBOR interest rate market, right? Or SOFR as it's moving to.
Okay, I guess this sort of requires some sort of specificity about what regulated means. I mean, it's not clear that some random South Korean bank 40 years ago could borrow and lend those dollars or exchange them freely with people at par or at the London standard sort of rate. And again, they still were subject to whatever their local KYC and whatnot requirements were. It's not a situation where banks in London that were all, reasonably solvent, equivalent, whatever, credit quality branches of places from the United States and Italy and Germany, whatever, were all vaguely interchangeable. But some random South Korean would show up and their borrowing rate would be much higher, and everybody was still following kind of the same rules. Here it's closer to a Thunderdome type situation.
It is exactly the same as CBDCs will be. Is the Fed basically controls the globalized money supply. The US economy is 25% of world GDP, but the US dollar is 87% of world trade, right? So they've won. It's complete network effects. It is the most mature, saturated network on Earth is the use of dollars. Now, we're going to see South Korea speak to Janet Yellen. I think she's there next week, and they're going to say, "Please, Miss Yellen, can we have another swap line?" And they will say, "Yes, if you play ball with us, and we will use it for geopolitical aims because we own the dollar."
Okay, but I mean that's the opposite side of the sort of line about how the Russians had all their dollars taken away from them and how everybody is subject to U.S. rules. If you're going to do it that way, then you've just changed one regulator for another. I mean, you've swapped the SEC for the Fed or whatever the U.S. banking regulator is.
But again, you're obsessed by CBDCs, and I don't care about them. This is you're trying to get me to care about something I don't care about, which is the CBDCs, right? It's like, well, it's like this, it's like this. I'm like, maybe, and it doesn't matter. That's just the fiat on ramp to a larger world.
Okay, so I guess it's not that I'm not trying to get anybody to care about anything, but I mean that's the biggest use case people have found so far. I mean, some of it is clearly.
Again, we go back to the 1997 conversation of what was the use case of the internet. It certainly wasn't bloody video calls and all of the shit that we're seeing now. We do not know, as with all technologies, unless you are a true visionary, you have absolutely no idea what blockchain technology is going to be enabling in 15 years' time. Zero.
Okay, I guess I'm not going to pretend I can predict exactly whatever. But, most of the stuff that's on my phone, right,
you even admitted,
it's just more efficient versus email.
You even admitted when you saw the Google search engine, you thought, this is ridiculous. Why would anybody do this for free? This is not a business model, right? That's the order of magnitude of mistake you make with forecasting from what you understand by looking at today.
No, okay, that's completely fair. That's completely fair. I guess in that case, it was a product that had no competitors and it was not possible to see the revenue. In this case, my question, this is not a criticism of the space. I'm trying to understand how to navigate the space.
But you're asking about CBDCs again.
No. Okay, so my multi-currency stock exchange sort of thought experiment. It's hard to see how that doesn't just get costs competed down against existing software engineering improvements.
And so it should.
Okay, so I guess in that case, it's just sort of a better database and transfer technology, but it's still fundamentally the same stuff. I mean, it's a Cayman SPV with an anonymous trustee.
Why does it need to be the same stuff?
I guess we have yet to see what the new stuff is, and it's trying to.
Christ, we barely started. I mean, we have barely started in what we are doing. I mean, NFTs didn't exist in any meaningful format 2 years ago. So that was an entirely new construct around a smart contract that has enabled extraordinary amounts of value to be created in its first cases alone, without understanding that an NFT is basically a unique contract that is immutable on chain and transferable.
I guess I don't want to debate the newness of NFTs because there are certainly things that are new, things that are not new, whatever it is. But the concept of uniqueness and collectibles is fine. It's a transfer modality and a sort of value accrual to the group that's the thing that's different. And, fair enough, that's different. But to the extent that's just a way of avoiding existing rules, it feels like that's not sustainable long term. it may be more efficient. Lots of things are efficient, but are not really
What rules are we talking that it's getting around?
I mean, some of the stuff are sort of collective investment schemes in some sense, right? To the extent you believe these things are replacements for Cayman Island SPVs, right?
Which are, sorry, again, I'm so confused with your references because they don't seem to make, they're of a different order. So is a DAO a Cayman Island SPV? Well, half of them are in here. That's just a legal construct because they're not centralized. When we talk about NFTs, there is no real example of this in the world. So in the digital world, as you quite rightly say, everything that gets digitized goes to zero in cost. Everything. And that will not stop. What an NFT does is create digital scarcity. Digital scarcity stops that process. That's why it's such a big and important breakthrough.
I guess, okay, I mean, certainly that particular sequence of, I mean, we're getting too sort of in the weeds of the technicalities, the difference between a collectible, a physical collectible, and an NFT. I suppose back to the SPV, the Cayman, whatever, like the idea that these kinds of structures exist as legal dodges or as ways of avoiding sort of an existing system that's reasonably clear. This is not a moral judgment. It feels like that may be difficult to sustain without some kind of clearer framework under which to operate these things.
Which part of the ecosystem are you talking about?
So, to the extent of DAO, any of the Solend example is a good example, right? To the extent that this group voted to take somebody's money, take somebody's tokens, liquidate their tokens, OTC. How you avoid some ambitious legal system trying to go after that? I mean, we need a way for that to become tighter, or people are simply going to set the precedent that that's no longer decentralized and that guy's in charge, right? It remains unclear.
And that needs to get tested through the court. I mean, that's if it's not truly decentralized and they're trying to use it just as a way around regulation, the regulators will get them. And what we're going to find is actually some sort of compromise. We're seeing the acceptance of DAOs in states in the US already as a legal structure. So there's going to be some, like there is with regulated securities, there's going to be some criteria by which it meets the idea of this is a DAO and it's distributed in nature and therefore it's not a corporate entity. So, that's to come.
I mean, I haven't seen sort of concrete rules that have been passed that codify.
Yeah. Have a look at members. Have a look at Wyoming.
No, but they don't have something that says that the members of a DAO are completely immune from liability for sort of the collective decisions of the group, right? It's ways in which you may be more or less responsible. It's a fair point that this is going to be tested, and I guess maybe my answer.
And some will pass, and some won't pass.
Yeah, maybe my original question, the answer is we have to wait to see who makes it through the hoop to figure out what is and is not of value because stuff gets judged. Fair enough. That's the way finance works. Finance is familiar with the legal dodge that gets tested. So, okay, maybe it's a decade of experimentation and coming back full circle on that one, I suppose. I don't know. I mean, you had looked
DAOs are relatively new in contract. Yes, they've been around for a bit, but we're still talking like 5 years. So, we've not gone through the testing, the legal cases, the challenges, the regulators, the failures, the successes, the learnings. The issue I have with a DAO is it's pretty difficult to get a company, even if it's not a company, a group of people organized in a decentralized manner because crowds are not very good at making decisions.
Humans are not good at being decentralized. No, that's a lesson of Greek tragedies. That's fair enough. I mean, so coming back maybe to the very beginning, you had 15 years ago or so looked at setting up what you had referred to as the world's safest bank. And I wonder, clearly some of the issues there connect to the problems that we're experiencing in this space now. I wonder how you think the lessons you learned from that connect to this. I mean, one of the issues is, of course, it's hard to make money because the margins are thin. You have to follow rules, sort of how that connects back to the difficulty of setting up.
It was nothing to do with that. That bank was going to have full non-rehypothecated segregated assets. So you put $1 million deposit in, it would own $1 million of US treasuries, non-reuse. So like a gold vault is. So that was the idea. So therefore, there were all claims on assets. And you would create margin by creating services as opposed to lending and borrowing services to create it, right? Because there was a group of people who would like their assets not to be taken like it happened in Cyprus. I lived that whole thing in Europe. So that was the thing. And then I saw Bitcoin and blockchain and I realized I didn't need to do it because it solves that problem.
Okay, so
Proven
I guess
ownership of asset.
Okay, so I suppose, there is cost to running a blockchain network. Again, this is not a positive or negative, right? So the issue you had, I guess, setting that up was the cost of running such a bank because there's no revenues in it.
No.
Okay.
It was just the complexity of dealing with regulators and saying we don't want to be borrowers and lenders. We just want to hold treasuries, but we want it as a bank structure. The regulators, Singapore, we did it in Singapore. We almost did it with the Singapore Trust. It was just too complicated, too slow, too painful. So we just didn't do it because I saw a cheaper, faster, quicker, more efficient, technologically interesting solution to that, which was blockchain.
Okay, because it's interesting for me because when I look at that, I think I guess one of the problems is financing the equity capital because you don't really need it if there's no risk being taken. And somebody has to pay to run the network. The Bitcoin miners get paid out of something. The dollars come from somewhere, or the yuan, or whatever's paying the electric bill. To me, those feel like similar problems. I guess you're saying you feel like the network externalities can be covered from different use case efficiencies, and it's not really an equivalence. Is that a fair summary?
It is a lot cheaper to store an asset on a blockchain than it is to store it in a bank.
Yeah, but you got to run a blockchain. That requires more computers.
No, they exist. I don't need to do anything. They're there.
No, but somebody has to inject dollars to cover the thing, right? It's not...
What do you mean? Who's injecting dollars into Ethereum?
Well, the miners have to get paid for their electric bills. I can run a money market fund on my laptop. That's not meant to be an equivalence. They're not the same service, but there has to be a capital inflow from somewhere. This is old sort of EMFX terms.
Yeah, but when it goes to proof of stake, that doesn't happen. All you're doing is securing the network. You're not mining for the network. What the network does is generate the revenues because of the use of the network itself. So it's just a whole different, it's not a centralized way of doing it.
The network generates revenues, but it's still a sort of return on capital, right? So if you don't have to buy the machines.
There's no capital. You don't need to put capital in.
You got to buy the coins and deposit them, right? Proof of stake has a capital injection. It's the stake.
No, sorry, you're misunderstanding. You don't even need a bank.
No, there has to be a stake. There has to be some stake for proof of stake.
I don't need a bank in a Web3 world.
No, but there's a capital cost for the stake, right?
I can now store any asset. I could store a video of us talking, put it on chain. That cost me $5, and that's it, right?
Sorry, so I'm not speaking from a bank regulatory perspective. I'm saying if you need me to inject $1 million worth of ETH for my staking, I would like to be paid cost of capital.
Again, we're talking completely cross language. You asked me why I didn't set up the bank. I said it was too complicated, and I saw blockchain and realized that what was a problem was I trying to solve? I didn't want to own a bank so I could make money. I was trying to solve the issue of you don't own your own assets, not at DTCC level, not at bank level, not at any level. So if you have assets, they can be taken away from you. So, and gold is a clunky solution because you have to stick it in vaults and do that. And so what other way could do it? And blockchain was a way of recorded ownership of assets that was immutable and distributed in nature. So therefore, it was always verifiable.
Okay. I don't think anybody would disagree with that description of sort of blockchain asset records. I guess it's that someone has to pay to run the computers to run the thing, and it's
the network activity pays it.
Yeah. Okay. So I guess the assertion is that the fees get socialized in a way that in finance with free bank transfers they don't, and okay, that's a different model of running the thing.
Absolutely correct. I mean that's why you pay gas fees.
Yeah,
So you
yeah,
pay
yeah,
gas
yeah.
fees in Ethereum to reward the network for the use that you've had. So you have to do two things to use the network. One is to buy the underlying a token or share of the network, which is buying ETH, let's say. And two, you need to pay a revenue for using the network, which is the same as your mobile phone, whatever internet you're on now, you're getting charged to use the network. You just don't own a stake in the network and you don't have to. So therefore, the network is just the fee. So it's a utility as opposed to an equity.
Yeah, okay. I mean, that generates a return that can pay sort of a cost of capital for the stuff that's staked. The people providing the stake will want to receive some return. It's a fair point that maybe they want to receive a variable return out of some network activity, whatever nebulous. That's fine. That's a totally different model where, generically bank equity holders in the old days got a vaguely regulated return. So, fine. Western Union shareholders got a properly regulated return. I guess that's a complete transformation of the setup. It does remove the.
That's what I was trying to say from the beginning.
Yeah, no.
In the network that you participate in is entirely different than anything that pre-existed. It never existed before. The ability to participate in a network like this. We identified the network that creates the internet, from the mobile phone companies to this to that. There's layers and layers and layers of this shit. You can't participate in the value of the network. Tokenization changed everything.
So, okay, but giving control over that kind of a structure, you lose kind of a lender of last resort facility, which is...
Yeah. Yes.
Okay, so crises become different to recover from. Crises become different. Okay. I mean, maybe it's
then
like
you have to use less leverage. It's just, you know what it's like. You've either got... You can either take your position and buy the put with it to protect your downside, or you lower your position size. I mean, it's the same bloody thing.
I guess the joke is you sort of, if the position loses enough money, you get fired. It's no longer your problem. But at some point, the bank isn't actually going to go under. I guess this is sort of betting that in the worst case scenario, the proper system burns down.
Again, go back to what is the issue with the banking system is nobody knows who the hell owns what. So Lehman goes under, you need the regulators to step in. In this system, you don't, because everything is proven. So it's just an unwind of assets.
No, sorry. I guess we're running out of time on that one. But like what we learned in the last 2 months is that whether it's a required feature, it's certainly an emergent feature, is that people have liabilities they can't meet. And nobody was able to construct a system.
Because what they did was recreate finance. That was centralized finance, not decentralized. Decentralized finance works fine. The liquidations just happen. Everything moves forwards. Nobody cares. There's no humans involved. With CeFi, somebody going, I'm going to lend 3 hours. It's long-term capital management all over again. One customer was everybody's biggest customer, and they blew up.
Okay, so if we accept this sort of couple of decentralized voting situations that seem to become a bit centralized, MakerDAO even had some weirdness. Fine. I guess then it becomes a question of whether or not that's an endogenous feature of the system and we can fix it, or whether or not we can't. And I don't have a strong opinion on whether one can do this without such centralized services causing trouble. I guess I wonder what you think would help steer things in a way that was less fragile going forward. Because clearly what emerged...
There's a really simple way of doing that is let people lose money. And they start tweaking the system to go, oh yeah, that doesn't work. Oh yeah, so maybe we need to have the lending book of the CeFi on chain so we can get verifiable proof of the risks that we are taking for the yield that we're receiving.
How is that not just treating this as another business cycle of regular finance, which is a reasonable thing to do, right? But it just means we're sort of step 452 of a,
But humans are humans. You can't get rid of the humans out of the equation. We're idiots. Boom, bust all day, and just give us as much leverage as we can. Oh, sorry, I've got too much leverage. I mean, that's the history of the world. The history of money is that. It's not going away.
No, I'm with you on that. So I guess maybe we can agree on that completely, right? So this is a way of maybe moving this somewhat forward, but it's just another, what's the science fiction show, Babylon, whatever, where they're all in the same cycles within cycles. So I guess it's sort of marginal improvement, but it's not new. It's just maybe slightly better. We have to keep trying. Okay. I mean, I don't think anybody's going to disagree with that one, right? Leverage seems to be a feature of the way humans deal with money. So fair enough. Yeah. And it remains unclear. Well, I guess I was just going to say we have to transact off chain because we have to eat. So it does really feel like there's no way to square this circle forever. But that maybe it's more efficient
because the CBDCs are going to be on chain. So therefore,
but it's permission chain, right? So permission chain is sort of halfway. It's not new. It's just software engineering, right?
But yeah, but again, nobody's saying it needs to be everything. And why should you be allowed to live in Singapore and not use their currency? Why should you? It's that you live in their state. But you also happen to live in the Ethereum state or the Bitcoin state or the Solana state or whatever it is.
No, I guess my point was that there's no Ethereum state because nobody grows vegetables in a place that takes Ethereum. But maybe if somebody does, you move to Arthur Hayes' country and we can buy vegetables.
Why does that make it a state?
Okay.
A state is a means of coalescing a large group of like-minded people around a similar set of values, usually with a system of money at the center of it or value exchange that is consistent amongst the entire state. So, and usually there's an organizing set of rules and principles that may or may not be a leader or a mythology with which, I mean, Noah Harari's book, Sapiens, goes through this in detail. I would also urge you to read Balaji's Network State books. There's a lot of this, and it doesn't need what physical infrastructure needs because it's a digital state.
Okay, no, fair enough. It's an interesting trade-off with the lack of lender of last resort and sort of the bad state of the leverage crisis going more pear-shaped. But that's a legitimate trade-off. So I guess we can agree on that. That's a choice you have to make, right? You can't. Fair enough. This has been a fascinating conversation. I see you have to get moving shortly.
Yes.
No, it's really been enlightening to probe sort of the edges of the way stuff goes. So I know sometimes you don't get pushed so much in weird directions. So, I hope that's been interesting for you as well.
Fabulous. Yeah, super interesting.